All right. With merger and acquisition and corporate buybacks picking up, are companies angling for short-term gains over long-term profits? Is it an attempt to appease shareholders? Oh, my gosh. Joining us now is Keith Springer. He's the president of Capital Financial Advisory Services. Bob Auer, senior portfolio manager of the Auer Growth Fund. Keith, oh my gosh, the shareholders are the capitalists. What is wrong with rewarding the shareholders through buybacks or even dividends?
Well, you've got to do something for the shareholders, otherwise there's going to be a revolt. You can't leave money earning nothing in the bank, right, Larry? So they've got to go out and do something, and it's a great opportunity for some of these companies, the big companies, to really expand productivity and become more productive and more efficient. So it is a great opportunity for some companies. On the other side, you know, they are going to give up some of the long-term growth, but you can't leave it in the bank, right? I mean, you've got to do something with the money. Otherwise, investors are going to be banging down the doors, and they don't want to have to pay back in dividends because that is less productive. Mm-hmm. So these companies have to do something, and I think they're probably going in the right direction for some of the companies.
Mm-hmm. Bob, I mean, that's really the crux of this, right? I mean, they're trying to grow. They're trying to improve themselves overall as a company in what many consider a very tough time, but you need to find growth somewhere.
I think you need to look at the motivation for some of these mergers or acquisitions, and I would categorize them simply in three categories. They can be strategic. For example, take Intel. Intel buying McAfee, they're billing it as strategic. They think eventually they're going to be able to put antivirus software right on the chip. It could be to block a competitor, something you don't want your competitor to get, so you're maybe even willing to overpay because if it was in your competitor's hands, it could be very powerful against you. And the third category I would put these acquisitions or mergers is it's cheaper to do it this way than to start it from scratch. Mm. And so if I was going to look at a merger or acquisition, why is the company doing it, I would say, what is their motive? Is it strategic? Is it to block a competitor, kind of to straight arm a competitor? Or is it because it's cheaper for them to do this than go out and grow it organically? And sometimes it's all three.
But Keith, let me just come back to this. I mean, a lot of shareholder investors say that the corporations do not spend their cash very wisely, that they make very bad decisions, whether they're M&A takeover decisions or whatever, and that they want to keep, the investors would rather keep their own money, thank you very much. I mean, it's sort of like taxpayers and the government. Let me keep my own money instead of letting the government spend it. Now, that's a little far-fetched, but what's your thinking on this? Why is it inefficient to let the investors get a higher rate of return?
Well, in dividends, a company cannot become more productive. It does allow companies to appease investors and pay them out a little bit. But we've got to remember, these leaders of companies are just like money managers. They've got to find opportunities in the marketplace for their money. They can't leave it in the bank. They want to become more productive. Ultimately, we'd love to see them hire more workers, but they're very cautious right now. So if you pay it out in dividends, you can't increase productivity for your company.
Let me just ask this. I don't mean to interrupt. Just want to follow up. Doesn't it force the management to be more efficient? I mean, that traditionally is the argument that, you know, a lot of tech companies, all right, including Microsoft, have gone out and bought stuff that made no sense at all. And the share price has suffered down through the years. And yet, investors would say, buy back the stock. Now, Microsoft has done this and pay me more dividends. In other words, it forces the corporate management to be more efficient in some cases, does it not?
Well, it absolutely does, and they've got to find these opportunities, but not all these managers are good portfolio managers. So what they're trying to do is find opportunities that allow them to expand without increasing workers or productivity or without increasing supply, because there is no demand. So what do? You go out and you find other companies that have products that you'd like to own, and you don't have to start up. And as your other guest mentioned, you might want to block another competitor as well. But yeah, yes,
well, Keith, and it's also a terrific time to buy. I mean, let's not forget that, right? I mean, there's a lot of companies out there that are looking pretty cheap, so they're saying to themselves, these CEOs, hey, I can go out there and acquire this growth. It's easier for me to do that, perhaps, than to invest in the research that I would need to build this separately.
Trish, you hit it right on the button, because it makes them much more efficient because of the opportunity. The other side is, think about what they're getting in the bank. They're getting 1/10 of 1% or zero if you've got a lot of money. You've got to go out and do something. So investors are going to require something. something. Dividends are not going to make you more productive. Even though the investors would like to see that, the corporate managers are not going to want to have to pay those out, so they want to show it in productivity. So, Trish, you hit it right on the head.
All right. I hear you. I hear you. I think the whole capitalist system is more productive, but that's great. Thank you, Keith Springer and Bob Auer. We appreciate it very, very much.